All right, let's dive in. Today, we're going to break down a really straightforward rule-based trading strategy I came across from the Trading Lab channel. Now, the whole idea here is to work with the market's momentum, not try to fight it. So how do we actually do that? Well, let's break down the 3 simple rules. And I love this quote because it just nails the entire philosophy here. The goal isn't to be a hero, right? We're not trying to predict the exact top or bottom. We're just trying to see which way the river is flowing and then just hop in a canoe and go with it. It's a game of probabilities, not prophecies. So this really boils down to 2 different mindsets, right? On one side, you've got the gambler. This is the person trying to catch a falling knife, betting they can pinpoint the exact second a price will reverse. It's super high risk and, frankly, a low probability bet. But then you have the strategist. That's who we want to be. The strategist waits for the trend to prove itself and then just joins the ride. It's all about putting the odds in your favor. So, how do we actually stop fighting the market? Well, this isn't about guessing or having some magic gut feeling. It's about pure discipline. We're about to walk through a crystal clear 3-part system designed to do one thing: align our trades with what the market is already doing. And that brings us to rule number 1, and honestly, this is the most important one. Ride the trend. Before we do anything else, before we even think about placing a trade, we have to answer one simple question: which way is the market going? Everything else we're about to talk about is built on this foundation. The main tool we're going to use for this is the exponential moving average, or the EMA. Just think of it as a smooth line that follows the price. And the key word here is exponential. It gives more weight to what's happening right now, which makes it much more responsive to the current market mood. Okay, so here's the rule, and it is dead simple. We are only interested in looking for buy opportunities when the price is trading above this big 200 EMA line. You can think of it as our buy zone. If the price is below that line, we don't touch it. We just sit on our hands. It's a clear, non-negotiable filter that helps keep us on the right side of that major trend. And hey, setting this up is super easy. In TradingView or pretty much any charting platform, you just go to your indicators, find the exponential moving average, and change the length setting to 200. Boom, your foundation is now on the chart. Okay, so we figured out the overall trend. Great. But is there actually any gas in the tank right now? Rule number 2 is all about confirming that buyers are actually in control at this very moment. We need to say that there's some real bullish momentum behind the move. And for this, the strategy uses a specific tool: the RSI divergence indicator. Now, a lot of traders use the RSI to look for overbought or oversold signals, but we're going to ignore all of that. For our purposes, we're using it for one thing and one thing only: as a pure momentum gauge. So here's the rule, the key takeaway. The RSI line has to be above its middle point, which is the 50 mark. When it's above 50, that's just a simple way of telling us that the recent upward price moves are stronger than the recent downward moves. In other words, the bulls are in the driver's seat. And just like before, setting this up is a breeze. You search for the RSI divergence indicator, pop into the settings, and you can just uncheck some of the extra boxes to clean up the chart. The main thing is to make sure that middle 50 level line is nice and visible. Now, here's a really cool bonus feature of this specific indicator. It automatically spots something called bullish divergence. So what is that? It's when the price on the chart makes a new low, but the RSI indicator down below actually makes a higher low. It's kind of like the momentum is secretly building up strength under the surface. Now, to be clear, this is not a required rule in our checklist, but if you see it happen, whoa, that's a really powerful extra confirmation. All right, we're at the final piece of the puzzle. Rule number 3. We've confirmed the overall trend is up. We've confirmed the short-term momentum is bullish. Now we just need that one specific signal, the green light that tells us, okay, it's time to go. And that signal is a very specific pattern called a bullish engulfing candle. And this pattern is, it's just such a powerful visual, right? It's when you get this big, strong green candle that completely swallows or engulfs the previous little red candle. It's a sign that the buyers have just stepped in and completely taken over from the sellers. Okay, listen up, because this part is absolutely critical. You do not jump the gun. You only, and I mean only, enter the trade after that engulfing candle has fully formed and closed. So many times a candle will look like a great signal halfway through, but then it completely falls apart by the time it closes. Patience here is what saves you from a ton of false signals. And hey, to make your life even easier, you don't even have to hunt for these patterns yourself. You can just add an engulfing candle indicator in TradingView and it'll do the work for you, automatically flagging them with a nice little arrow. Okay, let's recap. We've got our 3 rules. We have the trend, we have the momentum, and we have our entry signal. Now let's put it all together and see how this thing actually works in the wild with a full trade example. So, before we even think about clicking a button, we run through this super simple 3-part checklist. Number 1, is the price above the 200 EMA? Check. Number 2, is the RSI above 50? Check. And finally, number 3, did a bullish engulfing candle just appear and, importantly, close? Check. If we get 3 checks, we have a valid setup. Okay, so check out this chart. First thing we look at, is the price above the 200 EMA? Yup, clearly. So rule 1, check. Then we look down at our RSI indicator. Is it above the 50 line? Yes, it is. Rule 2, check. The conditions are perfect. So now, we wait. We're patient. And then, bam, there it is. A beautiful bullish engulfing candle forms, and our indicator even gives us that little green arrow to confirm it. We wait for that candle to officially close, and the second it does, we enter our buy trade. Now, as soon as we're in the trade, the most important part begins, managing our risk. We immediately set our stop loss just a little bit below the low of that entry candle. Then for our take profit, we just measure that distance to our stop loss and set our profit target at twice that distance. This gives us a solid 2-to-1 reward to risk ratio. And I really want to hammer this point home. This 2-to-1 ratio is so important. It means for every single dollar we're risking, we're aiming to make 2. Having a setup like this means you don't even have to win every trade. In fact, you can be wrong a fair amount of the time and still be profitable in the long run. It's a mathematical edge. You know, this quote from the original video is probably my favorite part because it gets to the heart of what makes trading so hard. It's not the charts, it's our own emotions. Once your trade is placed, with your risk and your profit target defined, the best thing you can possibly do is just walk away. Let the strategy do the work without you hovering over it, tempted by fear or greed. And that really leaves us with the big question, doesn't it? The strategy itself is pretty simple, just 3 clear rules. Anyone can learn them, but having the patience to wait for that perfect A+ setup and then the discipline to follow your plan without messing with it, is that the real challenge? It's definitely something to think about.